Hello, this is Daniel Rich, equity analyst at CFRA, covering the utility sector. Today, I will be providing some thoughts on fundamental and valuation trends, as well as our outlook for utilities heading into 2023. Before I begin, I want to remind all viewers that this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activities. So on this slide, we can see that utilities have largely outperformed the broad market measured by the S&P 1500, lagging only the energy sector in terms of year-to-date performance. With historic inflation, aggressive interest rate hikes, geopolitical risk from the Russia-Ukraine conflict, and fears of slowing economic growth or potential recession, we think investors understandably fled to safety in utilities, often viewed as one of the most defensive industries. While the macroeconomic picture remains unclear, we have concerns about utilities being able to maintain their momentum. Our current sector recommendation for utilities is underweight, balancing what we view as mixed fundamental trends, elevated valuations compared to historical levels and forward growth expectations, and less favorable risk-reward opportunities in the current interest rate environment. This next slide is from Duke Energy's second quarter earnings presentation. It presents a clear overview of the key earnings drivers for electric utilities like Duke Energy. For context, our estimate of Duke's 2022 adjusted earnings per share is $5.45 per share. From a fundamental perspective, we see the near-term outlook for utilities as a mix of positives and negatives. Of the three components listed for electric earnings, we have a positive view on rate base, the assets from which a utility derives its regulated revenues. Capital spending expands utility rate bases and provides an opportunity for new rate increases. The next slide shows that in 2022, we expect capital expenditures by electric, multi, and gas utilities to reach near $138.7 billion, which would be an all-time record, representing 13.4% annual growth. In 2023, we expect somewhat slower growth, near 5%, but another all-time record, near $145.7 billion. These expenditures are primarily for electric and gas infrastructure improvements, as well as renewable power generation such as solar, wind, and battery storage. We expect utilities to play a large role helping the United States power grid gradually shift away from coal and natural gas towards fewer carbon emissions. We also think the long-term backdrop for clean energy investment got a significant boost from the recent passage of the Inflation Reduction Act, which allocates close to $370 billion towards U.S. energy security and climate change initiatives, including extension of the nuclear production tax credit beginning in 2024, as well as zero emissions credits for solar, wind, battery storage, and other clean technologies starting in 2025. Looking at the next slide, we have concerns about one of the most significant components of electric earnings, which is authorized return on equity. Authorized return on equity is the maximum return a utility is allowed to earn on the equity component of its rate base. Higher authorized return on equities can be a significant earnings driver for regulated utilities. They typically correlate to broader interest rate trends and have trended downward over the past few decades due to a lower interest rate environment. We had assumed that authorized ROEs would begin to trend upward in this rising rate environment. However, as of August 9th, the average electric utility authorized ROE in rate cases tracked by Regulatory Research Associates, which is part of S&P Global Market Intelligence, was 9.37%, flat with the full year 2021 average of 9.38%. Average gas utility ROE was 9.41%, which was below the full year 2021 average of 9.56%. In an April op-ed written by Mark Wolf, director at the National Energy Assistance Directors Association, Wolf wrote that over 20 million American families were behind on their utility bills, collectively owing near $23 billion. With consumers facing rising energy bills, utility commissions are currently under pressure to blunt the effect of inflation on the retail customers. Given these factors, particularly in this midterm election year, we think utilities could face strong opposition in their upcoming rate cases. And to wrap up the fundamental picture, we see U.S. retail electric sales growing slowly in the near term. The U.S. Energy Information Administration, or EIA, recently forecasted that annual residential electricity sales will grow between 0 and 1% this year, while commercial and industrial sales are expected to grow 3.2% and 4.0% respectively. In 2023, the EIA sees flat to negative 0.5% growth in residential and commercial electric sales, while industrial sales are expected to grow 3.1%. Many utilities have benefited from recent strength in industrial electric sales, but these also happen to be the lowest margin customer segment for utilities, while sales to residential customers tend to produce higher margins. Looking ahead, we think a potential recession would slow electric sales growth, as less new housing, more unemployment, and weaker industrial output could all have a negative impact on electricity demand. Moving to the next slide, from a valuation standpoint, we think utilities offer an unfavorable risk-reward opportunity. On the next 12 months basis, as of August 26, utilities traded at a 21.3 times forward price earnings ratio, which is a significant 30.9% premium to the historical average since 2005. Electric utilities traded at an even wider 34.1% premium. The broader market, measured by the S&P 1500, traded closer to its long-term forward price earnings average at 17.4 times, which is just a 6.9% premium. The utility sector price earnings to growth, or PEG ratio of 2.8 was also well above the broad market ratio of 1.3, suggesting utilities could be overvalued relative to other parts of the market. Another relevant measure of the risk-reward trade-off for utilities is the comparison of utility dividend yields versus U.S. Treasury yields, shown on the next slide. Data from the U.S. Department of the Treasury shows that as of August 26, the daily par yield of a one-year Treasury bill was 3.36%. A 5-year Treasury note yielded 3.2%, and a 10-year note yielded 3.04%. Meanwhile, the average dividend yield among stocks in our coverage was recently around 3.0%. From a yield-seeking perspective, investors can earn a comparable, if not higher, yield in theoretically risk-free government offerings and avoid the risks of falling dividend yields, dividend cuts, and declining share prices that could occur in utility stocks. The next slide is a snapshot of our current utilities coverage as of August 31st, 2022. The companies are ordered by market cap from largest to smallest. Fortis Inc. is a Canadian utility shown at the bottom, which has significant operations in the United States. Electric utilities comprise around 60% of the sector's market cap, followed by multi-utilities near 30%. The final 10% is made up of gas utilities, water utilities, and independent power producers. As a reminder, CFRA's STARS rankings run from 1 to 5, with 1 being a strong sell and 5 being a strong buy. And with that, I will close by saying thank you very much for tuning into this presentation. Please make sure to check out CFRA's MarketScope Advisor website for our latest utilities research, as well as detailed reports on individual companies in our coverage. Thank you and have a wonderful day.